Hey everybody, welcome to the second episode of Hugh Knows, where we break down all things economics and mortgage and housing related.
Oh yeah.
If you didn't tune in for the first one, I'm Austin Baker with Jonathan Bunk and Hugh Hartzog. And Hugh's gonna walk us through some information that he's been tracking. So quick overview of what the episode's going to look like. We're going to be going through some macroeconomics, so looking at national information, what's going on in the economy. We're going to zoom in to Houston. We're going to look at what's going on in the Houston economy, and then we're going to zoom in further and look at Houston housing information, as well as some mortgage-related information. So hopefully this is helpful to you if you're a realtor or if you're a home buyer or a home seller. This is what we're looking at, and maybe it gives you a little bit of context for you as you're trying to make your decisions. Now, that being said, we are not financial advisors, so don't take any of this as financial advice, nor does anything we say represent Network Funding's opinion, our parent company's opinion on anything. So this is just our own personal opinions, looking at the data, and we're just going to be riffing as we see it.
That's right.
So
sounds good.
Without further ado.
All right, so you should be seeing on your screen now, which basically has two charts. One on the top left shows the federal funds rate, both the upper target and the actual federal funds rate, and then in the green area, it's showing the 2-year Treasury yield. So basically, what this is showing is over the past couple of years, we've seen really low rates, and that's mainly been due to, as we all know, COVID. Which struck, that had big impacts on jobs, but also on supply chains. And as economies reopened, inflation was spurred. So you can see in the top left-hand chart, there's a sort of a buildup of interest rates prior to COVID, and then they're dropped really low, and yields on 2-year Treasury bonds also dropped really low. And then because inflation starts picking up over the past 2 years, in response, the Federal Reserve raises interest rates to kind of try to bring down prices. And then also on top of that, we've had some other big events. I'm sure both of you are aware, as all of our viewers are aware, of things like the Russia invasion of Ukraine, which really drove up energy prices. And so I'm showing inflation on the bottom left-hand chart, which you should be able to see on the slide. I'm showing two measures of inflation. One is the CPI, and the other is the Personal Consumption Expenditures Index, the PCE, which is, by the way, the Fed's preferred measure of inflation. And what we've seen is that as interest rates have risen very quickly, we've started to see inflation come down. So you can see that there seems to be a plateauing of inflation.
Hallelujah.
Late last year, and the last couple of readings have been positive for both the PCE and the CPI, showing prices decreasing. So I don't know if either.
So it looks like it's working.
Yes, that would be one takeaway.
Yeah, and if you look back at the slide and you can see COVID coming, you can see the Fed just cut rates to zero. And also I remember people calling us like, "Are interest rates at 0%?" It's like, well, the money the banks and financial institutions borrow from the government overnight is at zero, but the money that is lent out to you for a mortgage or a car loan is not at zero. But you can see they did that because COVID put us into a recession when everybody was locked up at home. And one of the things we heard, Hugh, is like the Fed stayed at zero too long. And you can see that flat line for, I guess, almost 2 years where it held rates at zero. And a lot of people think the Fed reacted too late going up. And that's when we got all this inflation that happened.
Right.
Yeah, and I think on that point as well, the Fed gets a lot of flack, and rightfully so. But I think we can also tip our hat to them, and that, you see, man, they dropped the rate to zero, and we know exactly what kind of impact that had on the housing market. It was amazing. We had an incredible 2-year run. If you were a realtor, mortgage lender, we had an awesome run for those 2 years with the Fed keeping their rate at zero. And so, man, that helped, so we got to tip our hat to that. That kept the economy going during COVID. We were the bright spot in the economy. But then obviously inflation starts to take off. They have to deal with it. They've got to raise their rate. Now, I think what they should have done is also kept buying mortgage-backed securities, my own personal opinion, but they stopped doing that and they raised rates. But you can see that the correlation of them raising rates is actually helping
stop inflation.
Slow down and stop inflation, which is critical. I mean, we cannot have unhinged and
inflation,
runaway inflation would be disastrous
Right.
for our economy forever.
Yeah.
You know, it's like the short-term pain for long-term gain. We're experiencing that right now. And so in my view, just looking at these two charts, Hugh, I look at this and I go, okay, yeah, we can argue about whether or not the Fed kept it down too long or did it too late, but the things that they're doing in the end are working.
They're starting to have some impact, and so that's definitely a positive sign.
Yeah, and if you're a home buyer realtor, inflation is the number one driver of mortgage rates right now. So that's why what we're talking about right now is so critical to understanding. And now we're positively seeing inflation come down, which is good for mortgage rates.
Right. So on this next slide, you should be able to see on your screen now the 30-year fixed mortgage rate. And this is from Mortgage News Daily. And this chart shows from November 2021 through November 2022. Those are the from low point to peak. Rates have increased 4% on 30-year fixed conventional mortgages. And so that's reflecting this tightening of monetary policy by the Federal Reserve, because even though it's not a one-to-one correlation, what the Federal Reserve does definitely will impact mortgage rates. And as we've seen the Federal Reserve increase mortgage rates in their interest rates, we've seen mortgage rates increase as well. And of course, all of that is in the backdrop of inflation. As Jonathan said, that inflation is really the thing that's being considered behind all of this. So massive historic increase in a very short amount of time for mortgage rates, and that definitely had an impact on the economy.
If you're a real estate professional, congratulations for surviving last year. Like when I look at this, I'm like, wow, what a wild, difficult ride that was. Yep. I mean, every month rates were just moving, and it's hard for sellers and buyers to stop, think critically, make decisions for them and their family. And as a realtor, lender, it was quite the year. So I'm glad to see things are heading downward now. Yeah,
it's a shock to the system. And one of the things we mentioned, like Hugh just said, the Fed has been the primary factor in the rise in interest rates this last year, but they're not the only factor. They're just at the moment the biggest impactor for mortgage rates. And so
absolutely. Yep. And obviously the chart on display shows that we've seen rates come down a bit since their peak, and so that's definitely been positive news. So all right, so this next slide is
H-Town.
Yeah, now we're pivoting to the Houston economy.
Yeah.
So this data comes from the Bureau of Labor Statistics, and this is how they break down the jobs in the Houston economy. This is as of 2021. So as you can see, there's a wide variety of categories of jobs. Some people might ask, like, well, where is energy in this? That's going to be sort of across a couple of these different sectors. Obviously, trade, transportation, utilities is going to have some energy exposure there. Professional business services, a lot of those services are supporting energy-related fields. But we have a huge healthcare sector. That's number 3, along with education. Rice University, University of Houston, all the medical hospitals that have teaching staff as well, and of course leisure, construction, manufacturing. So we have a wide variety of jobs in Houston area, so we're not just exposed to oil and gas is the main point there. So that might be a little bit different way of looking at jobs than people are typically see. They might see like X% of jobs are related to energy, but this is how the Bureau of Labor Statistics breaks it down.
My favorite one on here is mining and logging.
Right.
For Houston. I'm like, is that just CenterPoint coming through and chopping down our trees in our backyard for the power?
Yeah, what is it?
It could be. But I mean, if you're a realtor, and a lot of people are like, should I buy a house? What if oil goes down and that kind of stuff? It's like Houston has that diverse economy,
right?
Like you're sharing, Hugh, and so it's like that's great for preservation of home value. So if healthcare shifts or energy shifts, it shouldn't affect the job market, the labor market in Houston. Is what's just gonna hold values up.
Yeah,
better
for
than-
instance, like leisure and hospitality. I mean, like, you know, we forget that like NASA's here. Like, there's actually like reasons that people want to come to visit Houston outside of
Right.
you know, other, you know, oil and gas related.
Houston
things.
Open, rodeo.
Yeah, we have
NASA.
the rodeo. We have NASA. You know, obviously we have sports. We have you know, a lot of entertainment. We have an opera. You know, we have ballet. So it's you know, we have a diverse economy. We have over 50 breweries in the Houston area, which is also, if you're into that sort of thing, hey, it might be a good place for you. So anyway, moving on to the next slide. I got two charts on display. So the first one on the left, again, is from the Bureau of Labor Statistics, and what that is showing is oil and gas unemployment. And so that's the dark blue line, and you can see that we are at a fairly low point over the past couple of readings for unemployment for oil and gas in the United States. Actually, the lowest point that we've seen since about 2005.
Yeah.
So really strong, basically, employment for oil and gas workers, which is obviously, even though it's not all of Houston's economy, it's a big part of it. And so that's a huge positive in our view, that unemployment rate is still at quite low levels. Obviously, we saw that big spike in COVID. If you're looking at that blue line on the far right, you see that big spike, and that's due to COVID, and it's come down since then. The chart on the right, okay, so the green line is plotted against the left-hand axis, and that shows the total number of jobs in millions in the Houston area. And then the change in jobs by month is shown in the orange bars, and that's plotted against the right-hand vertical axis. So you can see that we had a big drop in jobs because of COVID, and we've gotten well past that pre-COVID level.
That's
so
amazing.
This is all industries.
This is all industries in Houston, yeah.
Okay.
Yeah,
And that's from the
amazing.
Federal Reserve Bank of Dallas.
That's amazing. And so, as a realtor, as a home buyer, you're like, why is job and Houston economy data so important? It's like, well, when people have jobs, they're
That's
getting
right.
promotions, they're getting bonuses, companies are relocating people. Guess what that drives? Real estate activity.
That's right.
So we want to see healthy economic and jobs and employment data like this here.
Right.
Yep.
Yeah, absolutely.
Life change is what drives the majority of home purchases. And so whether it's having kids, getting a job change, job transfer, promotion, those are the activities that cause people to want to buy a new house, right? And so very important for realtors to hone in on
Houston,
that.
you are doing well, and we are grateful.
Yep. On this next slide, it's kind of going right along with the previous one. So you should be seeing on the left hand a chart that shows the Houston area unemployment rate. This is all unemployment, so not just oil and gas, but just Houston area. And you can see that we had this big spike during COVID in April 2020, and we've come steadily down and are almost back to pre-COVID levels overall Houston unemployment. So that's very good. And then the chart on the right that shows Houston real wages. So that means it's been adjusted for inflation. Mm-hmm. So these are the real wages that people are making after inflation is factored in. And so what we can see is that we've risen quite a bit over the past year and a half. I don't have data for Q2 2022 shown here, but it was actually an increase back up to 60,000. So that trend has not abated. We're still rising as far as Houston real area wages, as far as the latest data that's available. And then the chart below it, this comes from a local research group in Houston, and basically it's showing the FDIC deposits, and you can see that over time personal bank savings deposits, savings checking deposits in Houston have risen, and they rose quite a bit in 2022. Now this is as of July 2022. I'm sorry, as of June 30th, 2022. So through halfway of last year, bank deposits had risen. So more cash available. That's also important for buying houses, obviously. Liquid assets on hand.
It's important for buying houses, but it's also important for foreclosures. right? When we see that people are sitting on the highest amount of, we know they're already sitting on the highest amount of equity
Right.
in history. And then on top of that, they're sitting on the highest amount of savings. People are not going to be getting foreclosed on. And as a realtor or as a home buyer, this is a very important stat because it requires foreclosures and a lot of them in the market to start to drive home prices back down, right? So without foreclosures in the market, that makes it really hard for homes to depreciate. And so this is a huge indicator in my mind to see that, because yeah, we've all been hearing about how much equity everybody has, but to see how much savings we have right now, highest level, you know, in the last, at least in the last 10 years, I would imagine looking at this chart, highest level ever. So that's
I think highest level ever. I'm not sure. I don't think these are inflation adjusted numbers, but these are just nominal dollar numbers. But definitely a very in nominal terms the highest it's ever been.
Yeah,
for sure.
So as you can see, we're painting the case that things are really good in the Houston economy and Houston real estate market. People are like, should I buy now? Should I wait? Our home's going to get better. If you've been following the story we've been sharing this morning, things are good, and it probably won't have a more opportune time to buy. We don't think home value is going to go backwards in Houston. And so, that's great data here.
it would take a catastrophe.
Yeah.
Horrible catastrophe for that.
Yeah, and we could talk about what would sort of have to happen in the next couple of slides and what would have to happen. So on this next slide, what you're going to be seeing on the left hand is the U.S. Gulf Coast refinery utilization. So this is how hard all the refineries are running. If you look at all the refineries in the Gulf Coast, how they have a max production that they could put out of gasoline and diesel, and what percent of that max are they running at as a group. So you can see the 5-year range in the green area. So that varies from down to 65% up to over 95% at some periods of time throughout the year. And you can see the 5-year average in the dashed blue line. And what the green is showing is last year's refinery utilization. You can see that for a lot of the year, refinery utilization in the U.S. Gulf Coast was at the top of the 5-year range, meaning that refineries were having to run very hard relative to history in order to supply the market with the refined products that the market was demanding. For instance, jet fuel, refined products like gasoline and diesel. So that's good for Houston because there's a lot of refinery petrochemical jobs that are associated with that industry. And then on the chart on the right, I'm showing oil and gas prices, the Brent price in the UK, and then WTI crude here in the US in the red and blue lines respectively. And those are plotted against the left-hand axis in dollars per barrel. And then the green bars show regular gasoline prices, and they're plotted against the right-hand axis in cents per gallon. And then the black dash line is $60 per barrel, which is where a large portion of oil production is at its break-even cost, meaning that it costs about $60 a barrel to bring that oil to market. And if prices are below $60 per barrel, then it's not profitable for them to produce the oil, so they stop producing.
Which means they stop hiring people.
And employment starts to fall. So the point here is that we're about $80 a barrel right now, a little higher than that. So we need to fall about $60 a barrel, or down $20 a barrel in order to get down to $60 a barrel. So we would need a substantial reduction in prices. And given what's going on with Russia and Ukraine, given that there's a relatively strong case for oil demand not falling off a cliff, i.e. it's not going back into lockdowns. Oil demand is relatively resilient during recessions. Its elasticity is closer to 1. And so you don't have a large drop off in demand when you have recession. So even in the case of a recession, oil tends to be a better performing commodity because you still have to drive to work. So any thoughts, guys?
No, I mean, this is all great news. I mean, like the refinery utilization, that just means the oil companies are sending them lots of oil, which means they're producing a lot of oil, which means they're hiring a lot of people, which means they're paying a lot of money.
Right.
So you follow cookie crumbs. It's like people are getting more money,
Yeah.
which means they're going to buy more house.
Yeah. I mean, to me, the takeaway is, Houston's got a very balanced economy. Oil and gas isn't everything, but obviously it's a major factor in the economy. And anytime oil's above, just simply, if all this stuff kind of makes your eyes glaze over, simple fact is if it's above $60 a barrel, that is good for the oil and gas industry, which means that's good for the Houston economy, which means that's good for real estate. So as long as oil's above 60, I think we feel good about that.
Yeah. So, all right. And then one more brief touch point on the oil side. So on this next slide, I'm showing the Texas rig count over time since 2019. This is the total number of rigs in Texas that are operating, producing oil. You can see a big drop off during COVID, and basic point is we're almost back up to pre-COVID levels as far as number of rigs in production. So again, good for local E&P producers like Apache and those sorts of companies that hire people based on the number of rigs. And then pivoting more to the consumer side, I have on display from the Texas Workforce Commission a number of Houston area restaurants. Over time.
Everybody's a foodie. If you live in Houston, you're a foodie.
Everybody loves our restaurant scene. People are impressed by it when they come from other parts of the other country, and they're like, I wasn't expecting it. And I'm always very happy when I hear that sort of comment, because I think we do have a great restaurant scene. Interesting thing to note, during COVID and after COVID, we actually increased the number of restaurants, right? So you can see in 21, we're actually increasing the number of restaurants, whereas a lot of other major metro areas saw restaurant closures and decreasing in the number of restaurants. And then, of course, in 2022, we saw a large increase, almost 400, or a little over 300, right there, in the increase in restaurants, which is just showing that, again, people have income that they're able to go out, and instead of only buying groceries, they're able to take their family out to dinner and enjoy some of the nice cuisine, which gives restaurant openers, restaurateurs, the confidence to continue to open up new establishments, and signals again, the strength of our economy.
Yeah, I was about to say, if you see people are eating out at restaurants, it just means they're bullish about their financial situation, they're bullish about their job situation, and they feel comfortable eating out and spending their money.
Right. Yeah, absolutely.
That's incredible to me. Seeing that, if you had asked me to just
do
guess, I would not have guessed this.
Yeah,
it's an incredible chart.
Cool. All right, so we're going to move on to the next slide here. So this is more moving to the trade and manufacturing part of the Houston economy. A little bit smaller portions of the economy, but still a big part of the major industries in Houston. So first, the Port of Houston container traffic. This is going to be a lot of different industries, not only import and export, but obviously oil and gas and chemicals are also being traded. As well as huge imports of cars and luxury items.
Yeah, a lot of people might not know this. Houston has the second, you might know, or third largest port in America. Next to probably Long Beach,
Los Angeles, and New York.
New York, maybe, which is crazy. So the whole Gulf of Mexico is definitely the biggest port in the whole Gulf, which is massive.
Huge, and we saw a big increase in container traffic. So those are the big containers they stack up and then put on 18-wheelers. So those containers, you can see this is in millions. So we went up to 1.8 billion containers through the Port of Houston, big number. And then the chart on the right is showing the Institute for Supply Management in Houston, and that's showing the Houston Purchasers Managers Index, which is basically an index of whether manufacturing is expanding or contracting. And so if the blue line is over the black line at 50, that means manufacturing in Houston is expanding. So it's come down a little bit, but we're still in an expansion phase. So moving on, I really like this next slide. What I've done here is there's a list of large Houston area employers, And I took that list and all of the Houston area employers that are publicly traded companies. So this includes like Chevron and Exxon and HP and all of the big publicly traded companies that have large employment presence in Houston. I put them on their own index, and so that's shown in the dark blue line. And then I've shown the S&P 500 index. So let's just call that a proxy for the wider stock market. I plotted that in the red line. And so what you can see is that the large Houston area employers, if you put them all together on an index, they have outperformed the S&P 500 since the beginning of 2022. And this is through earlier this month. So, and that's by a substantial margin, right? So you can see the percentage that we're outperforming the wider market, which is just signaling that the equity markets are seeing the companies that, again, have large exposure to the Houston employment market. Those large publicly traded companies are outperforming and have, at least the market perceives, better prospects than the alternative, which is the S&P 500. Yeah. So again, a huge, good signal to the market that Houston is a good place to be doing business. The companies that are doing business here have good prospects going forward, even relative to the wider market.
Yeah, I mean, so stock price 101. If a stock price is going up, this means there's a demand for that stock, right? So if you're an investment fund, private equity group, that means you're putting capital to work into these businesses. So if you're these Houston area-based employers, you're publicly traded, you're getting an influx of capital. What are you going to do with that capital? You're going to hire people, you're going to expand, you're going to pay people better. So back to the whole jobs, availability to buy houses. So it's like you want to see Houston publicly traded companies doing well from a stock market price just because it means money's coming into Houston.
And question I have here, Hugh, for the S&P 500 index, did you back out the Houston area employers out of that?
Yes.
Okay. So that is like real numbers, so that they're not still.
Yeah, I should have stipulated that's less the
ones that you pulled out. Yeah. Okay, cool. So you pulled out the ones that were from Houston. So that's the S&P 500 minus the ones from Houston, charted against the ones that are from Houston.
Right.
So, okay.
And not all the publicly traded employers in Houston are on the S&P 500.
Okay, so we've got additional ones that aren't. Okay, cool. Correct. So that's
got some in the Dow.
Right, because there could be different HP.
Yep.
I'm not sure which ones are traded on which indexes.
All you got to know is the money's coming into Houston, and that's good for.
There's demand for the stock for large Houston employers.
Oh yeah.
Right. So the economy nationally can be doing whatever it's doing, which that impacts all of us. But what really impacts us is what's happening on locally with our economy, and so this is an indicator that, like, man, things are better in Texas than they are everywhere else.
Right.
And we're not just saying that. There's data here.
Yeah, Houston.
Everybody says things are better in Texas.
Yeah. Well, I think it's bigger. Everything's bigger in Texas, but bigger is better.
Yeah. Amen. Amen.
All right. So now we're going to pivot and look at some data specifically relevant to the Houston housing market. So on display on this next slide, I have townhouse, condo, and single family sales. So the way to look at the chart is the vertical axis is absolute number of units. So and then I have the single family on the stacked bars on the left. So in the brighter colored, that's the single family units. The different shaded portions of the bar represent the different price points. And then the townhouse condo sales are on the lighter stacked bars on the right. So we did absolutely see a slowdown in the number of sales over the latter part of last year. There is seasonally a slowdown typically in later part of October, November.
Holidays, people
because of
spend
holidays,
time with family, travel.
But we obviously saw a slowdown in particular because of interest rates increasing. And the only thing that I would note about this chart that's interesting is typically there is a bump in December as far as sales, and we did see that last year. And the only point to make there is that that's a little interesting given how high interest rates had been, how much interest rates had increased relative to where they were.
Right.
Because if it had been me and I was forecasting at the beginning of Q4, let's say like in October, I'd been like, yeah, we're probably not going to see a jump up in December because interest rates are so high at this point.
Right.
So expect to buck the seasonal jump up in December, but we didn't see that, which is a positive sign.
Yeah.
So
we did get that little.
We did get that little Christmas pop, even though we saw interest rates. Now, of course, interest rates kind of peaked as we saw in that chart earlier in November, and actually we're already on the way down in December. So maybe that was also impacting things as well.
Yep. Yeah, that's a good little indicator to see that. That shows some normalization to me.
Yeah.
Right? Like it's kind of the last 2 years, the data's just been so whacked with COVID and with the Fed and all that stuff. It's like we're just hungry to see some normalization and seeing that, okay, man, we're having just a brutal second half of the year last year, but to see that little pop in December shows that there is some normalization happening.
Right, exactly. Exactly. You still have that seasonal effect. Okay, so that's all I wanted to say about this slide, so we're going to move on to the next slide. Okay, so what this is, slide on the chart on display is showing here is sales by month, 2021 and 2022. So the vertical axis on the left is where the green and blue lines are being plotted against. So you can see those numbers as they move throughout time. And then the gray bars show the percent change year over year for a particular month. So there was a 9% increase in January 2022 versus January 2021 in total units that were sold. And this includes both townhomes and condos and single families. So you can see the gray bars are plotted against the right hand vertical axis. And as we got to the middle of the year, we really started to see the Fed acting aggressively, being very hawkish on wanting to get inflation under control. And mortgage rates responded, not only looking at what the Fed was doing, but also themselves trying to price in the impacts of inflation. And so those rates went up quite a bit, and we started to see sales drop. And if you look at it for the full year, we saw about a 14% decline in sales volume for these types of housing units. But I think we were looking at some data the other day about other major metro markets, and you were making the point that those other major markets had seen much more substantial drops in the number of units, which I thought was a good point.
Yeah, I mean, every market went down last year, but it's like the Houston market go down at a smaller percent than the rest of the country. And you look at New York, San Francisco, Los Angeles, some of those bigger markets, and they went down 60%.
Right.
And on average, we went down like 30% from a sales volume. When I look at this chart, the biggest thing I note is like July is where I felt like, wow, things have really shifted.
Felt like we hit a wall.
Yeah, and that's where all the data says. So it's like if you were in the business last year or looking for a house last year, you could feel it in July where it kind of shifted from a heavy seller's market where we're getting 5, 10, 15 multiple offers on a house to July's like, hey, do you know what a seller credit is? And people in July were like, no, but can you teach me? And like that's kind of when seller credit started becoming a thing. That's when 2-1-3-1 buy downs, later in the fall became a thing. It's like pre-July, no seller credits, lots of offers. Post-July, seller credits, no multiple offers. And obviously there's still houses with multiple offers, but it's where the amount of them really dropped off. And so July was a very pivotal point last year.
Yep.
Yeah,
so
absolutely. But yeah, thankful that relative to other really large metro areas, Houston did relatively much better.
Mm-hmm.
Okay, so this next slide, what I'm showing is basically the ratio of sales to listings over time. So in the blue line, I'm showing 2021, and the green line shows 2022. So essentially, if it was 1-to-1, meaning that if it was all the way at 1, if the line was all the way at 1, that would mean that there would be one sale for every listing. So there would basically be no inventory on the market, or there would be no building inventory certainly, but basically any new inventory coming on would automatically get swept up. And so if you're about 0.5, that means, obviously there's 2 listings for every sale. But that's still indicating a really tight market. So you can see in 2021 that there was a pretty tight market for most of the year, and that has come down. That came down in 2022 last year. But if you look at what a neutral market would be, meaning that prices shouldn't be increasing or decreasing based on inventory levels, you need about 6 months of housing inventory. And right now in Houston, I checked last week, we're around 2.3 months of housing inventory. Ooh. And we're fluctuating between 2.2 and 2.3 months of housing inventory. So I estimate based on where we saw that sales to listing data end in December, we would need to come down, 38%, from that level to get to a neutral market, which is to say we're in a really tight inventory situation. Even though you are seeing more listings come online, we're still below that neutral inventory market level.
Yeah, I mean, everybody knows this. I mean, we're still in a heavy sellers market, even though we're not seeing as many multiple offers. But Austin was talking about foreclosures and things like that earlier. It's like that's the only thing that's going to move inventory is foreclosures, or people losing their job and having to downsize, or go from being a homeowner to being a renter, or if people had no equity in their home and they're upside down their mortgage. There's none of that happening right now.
Right. Yeah, prices have not fallen.
Yeah.
You still have a strong labor market because of the sorts of economies, the types of economies that we're exposed to here in Houston. And you have low inventory. So
so it's a technical way to look at inventory, but long story short, inventory is tight.
Yeah.
So
very tight.
Very tight. Okay. I'm not going to go through the table in detail on the left here on display on this next slide, but basically what it shows is different recessions and the impacts they had on the economy. So just looking at one in January, so the top, you can see in January 80 to July 80, there was a recession of 6 months. There was a drop of 2.2% in GDP, 1.2 million job losses, and unemployment peaked at 7.8%. Okay. And you can see that different recessions had different impacts on the economy. Obviously, the last one, COVID, being a major one. And then the table right below that is showing the Greater Houston Partnership, which is a group of research economists in Houston, and they focus specifically on the Houston area, and they forecast. And so this is from their annual forecast, and they're expecting in their baseline case, meaning their most probable case, that Houston will add 60,000 and 800 jobs. And you can see in their worst case scenario, they're expecting to add 30,000 jobs. So even in their worst case scenario in 2023, we're expecting to add jobs in Houston according to the Greater Houston Partnership, which is a really positive sign.
Buck the trend, baby.
Bucking the trend. Whereas if you see a recession in other parts of the country, they might have unemployment rise and job losses. Houston, given its exposure to the different industries that it has, maybe doesn't see that same level of unemployment.
Yeah.
And maybe even sees job growth.
Yeah, and I think that makes sense too, because what have we seen over the last few years, right? The Great Migration. So many people moving to Texas. It's been unbelievable.
Yeah, number one site for U-Hauls last year.
Yeah, and so, we got, whenever the economy is bad or things in the world are bad, people want to come to Texas.
Flee to freedom, baby.
It's like, so land of the free and the home of the brave. So this is an incredible stat that, I guess it's not a stat, it's a forecast, right?
Yeah.
From Greater Houston Partnership that even in their worst case scenario, they still see Houston jobs increasing this year. That's wild.
Yeah, and everyone's hearing about a mild recession or a rolling recession. So everyone's,
a soft landing.
All the pundits say we're going to have some type of recession in 23. And here's Houston saying, like, we're going to buck the historic trend that recessions mean job losses. Recession means Houston's still going to add jobs.
Right.
Yeah.
So that's basically it, guys. And I'm just gonna leave with this summary. Inflation has been high. So just looking at the final slide, but it does seem to have already peaked. And we do think that inflation is going to continue to come down. I think the Fed will probably end up raising their rates a couple more times. It doesn't necessarily mean mortgage rates continue to rise.
Yep.
But we do expect them to continue to be resolute and acting to tame inflation. We've already seen inflation come down. The Houston labor market remains tight, and there are some factors like the restrictions on Russian oil that kind of give support to oil.
It's not good for our cars anyway.
Over the next year or so, and that's good for the labor market. Obviously, we have healthcare and other industries, leisure, that continue to be strong as well. High level of bank deposits, real wages are strong. Inventory remains really, really tight. And then in the worst case scenario, local economists are expecting Houston to still add jobs. So we think this is a really positive message for 2023 versus what everybody would have been saying 6 months ago, all the doom and gloom. But there's definitely some upside. Even if it's not the greatest year that we've ever seen, we think that there's still lots of opportunity going to be around in 2023.
So if you're renting a house right now, homes will get more expensive, is our case for sure.
Yep.
So if you're willing and able, let's get you in a house. And if you're a realtor, you're like, all this great data, like, how do I put this into practice? I would say, look at oil every day. Like you said, if it's over 60, that's great to see. Look at the 30-year fixed rates. As long as we're in a downward trend, that's great for your business. Mm-hmm. And then look at inflation. You can see it in the news when the data comes out. We just want to see good news about inflation, meaning it's coming down. If those three things keep happening, we're going to have a great year, and that momentum is going to roll into a great 24 as well.
Yep, I agree. Hugh, we don't have this necessarily on a slide, but kind of off the cuff, what has changed for anyone that watched the first episode to now? Any big changes or any lead indicators that you saw from a month ago to right now?
So the biggest thing was that the CPI reading in December showed that prices actually decreased month on month. So what we have been seeing over the previous couple months is looking on a month-on-month basis, we had seen prices they were still increasing, but they were increasing more slowly. Mm-hmm. In December, prices decreased overall. So the CPI reading showed a decrease on monthly prices. And on a year-on-year basis, so they'll look at December 22 versus December 21, that year-over-year number was the lowest it had been in over 18 months.
Yeah.
So over a year.
Yeah, that was huge. That was a huge data
we've
point.
So we've seen that. We saw retail sales come down, and it was also revised for November. So we've seen 2 months of declining retail sales. That's seasonally adjusted because December is always the highest retail sales month because of Christmas and all other holidays. But when you seasonally adjust for it, retail sales fell in December, and they revised November's number. So that was a decrease as well, month on month. So we've seen 2 months of declining. So that sounds like negative news, but really it's positive news because it shows that prices are starting to ease. And so that's what we're really looking to see, because out of control price appreciation is essentially the worst thing that can happen to an economy.
Yeah, I mean, we've all felt it.
Yeah,
right?
exactly.
So seeing the prices, because that was kind of my big quip for the last quarter or so. Is it's like, okay, yeah, we're waiting for the rate of inflation to slow, but actually like seeing that
prices, exactly.
Prices tipped over for the first time. That is huge. So that was a data point we didn't have last time. Just further suggests that things are moving in the right direction.
Yeah, absolutely.
Awesome.
Cool.
All right, guys. Well, that's episode 2 of Hugh Knows. So now you know as well. We'll see you guys around. Holler at us if you've got any questions.
Adios.